My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Interesting action today, and I'm not talking about the Dow up 104 points, S&P up 0.81%, NASDAQ 1.9% jump. Wow. But ever since we got over the pandemic, Wall Street has punished the stocks that thrived during the worst days of COVID-19. The so-called pandemic names, they've been written off as returned to normalcy losers. Except for some temporary reprieves during the Delta and Omicron waves, they've either been dead money or totally toxic to your portfolio. And boy, have they weighed down on the NASDAQ. That is until today. Now, I'm not sure why. It could be because Elon Musk took a 9.2% stake in Twitter, a stock that performed admirably during the early days of the pandemic and has done awfully since. It could be because some major institutions simply decided that these beaten-down companies deserved a second look. I don't care. Let's take them one by one, starting with the poster child for the pandemic stocks, Peloton. Now, this stock traded up to 171, all right, early last year, before crashing down to $20 in one of the most ignominious swan dives I've ever seen. Too much inventory, possible cash crunch, poor management, the works. Even as the founder, John Foley, is a brilliant guy. Doesn't matter. With the crash and burn of the stationary bike stock, Peloton needed to bring in someone new. Unbelievably, they snared Barry McCarthy, the subscription mastermind who worked his magic at Netflix and Spotify. With McCarthy at the helm, I am bullish on Peloton. Even if this quarter's weak, I think it's worth owning as a long-term bargain, and today's 5.7% run makes sense to me. All right, how about the other pandemic poster child, Zoom Video? Eric Yuan. Paging Dr. Icarus. Zoom flew way too close to the sun. Right? Our Mr. Sun, tumbling from 588 to 94 in less than 18 months. So that is a move that's totally reminiscent of the dot-com era, isn't it? There's one difference, though. The dot-com obliterations weren't worth much because the businesses were never viable. Zoom, on the other hand, is extremely viable. It just got too expensive. Here's the real issue. It's still fairly expensive. It trades at 35 times earnings. Zoom simply must do something besides being a well-managed video conferencing company, or else it will wind up like the TV set companies of old. Think Admiral, RCA Victor. Too many competitors. There will be nothing special about a video phone soon. If they don't do something, if they remain as they are, then I say, count me out. I feel the same way about DocuSign, an incredibly valuable product that will keep being used and even expand its reach because their digital contract signing platform is just that good. But with COVID receding, more deals will now be done face-to-face because that's a tradition and lots of businesses are pretty hidebound. They're going back to some of their old ways. The fact that DocuSign still sells at 56 times earnings after it's plummeting from the high tells you it never should have been up here in the first place. So why would it stop at 112? Okay, so much of being cooped up, so much meant watching something, anything on television, and that's why Roku caught fire. But the stock flew from less than $60 to $490, an absurd climb driven by some overexcited money managers. Roku's now come down to 134, but even here it sells at a ridiculous 79 times earnings. Hey, the stock's down 7% today. Why? Because they extended their deal with Amazon, although I never thought that deal was in doubt. Unless Elon Musk takes a huge position here, I'm betting this will be a one-day move. Now, very complicated, particularly what happens later in the show. Doordash, all right, it fell from north of 250 to below 75 before rebounding pretty nicely to 127. Now, I actually have high hopes for this company long-term. Notice I said the company. But because it's losing money, I can't recommend the stock. This is an environment where profitability is king. That said, DoorDash is a really great story. It's locked up much of the country with its delivery networks. Smaller restaurants need to use DoorDash if they want to survive. There's no choice. Oh, and please stay tuned as we will have the biggest threat to DoorDash coming up right on our show. All right, how about Shopify? How about Etsy? Why anyone thinks of these as pandemic plays is actually beyond me, but that's how their stocks have been trading. I know that Shopify, the e-commerce enabler, is no Amazon. But then again, they never pretended to be, and there'll never be another Amazon. I think it works longer term, but the company still needs to grow into this market cap. Okay, nice move today. As for Etsy, now this one, I have no idea how to value this one. Nobody else does either. But its market cap seems way too small at $17 billion versus its opportunity. The online marketplace for handmade goods has unleashed talent all over the place. It's created just so many companies, but I'm really thinking about all the women who have been able to finally get a company. And Etsy has helped them. That is a long-term bullish trend. They built a huge platform here, and I think the stock deserves to trade higher. How about PayPal? All right, this is an online payments company that had been growing at 20%, even as they spent years disentangling themselves from eBay. I liked PayPal because it seemed like it was on track to become the best worldwide bank, something that would let them increase their growth rate and justify the $200 billion market cap plus. I was wrong. PayPal will be lucky to have 18% growth this year. I don't think they can do that. And whenever a growth stock sees that kind of deceleration, it gets crushed beyond all recognition. And that's what happened here with PayPal plummeting from 310 to 92, where it started bouncing. If you believe these guys can reaccelerate that growth rate, then the stock's a buy down here at 26 times earnings. Although PayPal will have to demonstrate a new level of consistency if it wants to justify even its $142 billion market cap. It doesn't hurt that Wells Fargo just initiated coverage of PayPal with an overweight rating, talking about a $1.5 trillion global market opportunity for fintech. But I got this one wrong. And Board of the Charitable Trust talked about a lot of the wins. This one's a loser and will remain a loser, and it's quite painful. Finally, I want to include AMD, which surged to above 160 last year, then fell to about 99, and it's worse in late January. I mean, that was just awful. AMD's two main businesses are CPUs and graphic chips, beating their hostage to the PCs. And many people believe we're seeing a PC slowdown because once you're building your home office, well, who needs another computer? But AMD's got huge exposure to gaming, and that remains very strong. All the major consoles are sold out. They're also a heavy hitter in high-performance computing, augmented by their acquisition of a data center plumbing company called Pensando that's integral to cloud build-out. And they've got telco exposure, courtesy of the Xilinx deal. CEO Lisa Su was on with me on Squawk of the Street this morning, talking about a 30% growth rate. Yet her stock sells at 27 times earnings. That's not ridiculously cheap, but it is normal cheap. AMD is one of the best semiconductor names, a very enterprise-oriented business at a time when enterprise is strongest of any of the customer cohorts. It's not a consumer company. The bottom line, when you see all the so-called pandemic plays roaring without any kind of upsurge in COVID, you got to take them on a case-by-case basis. But these were the companies that really did move the NASDAQ higher today. Some of these will be one-and-done moves, but I think the higher quality names have overshot their downside and can bounce for more than one day before they run out of steam. Erin in California. Erin.
Hello, Jim.
Erin.
Thanks for taking my call.
Of course.
Thanks for all you do for us.
Oh, you're quite welcome. Thank you. What's going on?
Okay, my question, and I sort of have two of them, is about Square, or Block as it is now known.
Right.
I bought Square around 32 because you tell us to buy what we know.
Right.
I'm a jewelry designer, and I use Square at my art shows. So my concern is with its exposure to Bitcoin now. I've ridden Square up all the way to 289. I still own it, and it's no longer at 289.
No.
My first question, do you expect it to get back anywhere near there now that it's attached to Bitcoin? And second question, should I consider owning Bitcoin because I now have exposure through it with Square?
Well, and Bitcoin is beyond my ken. I mean, I own Ethereum I can't own stocks, but I do own some Ethereum. I like it. My problem with Block, formerly Square, is that it's still very high multiple, and we're trying to stay away from the very high price earnings multiple stocks. You're up very big on it. It was up 11 points today. I think, Aaron, you should take a little off the table, even though it was much higher at one time. John in Colorado. John.
Hi, Mohai. Booyah, Jim.
Booyah. What's up?
First time, long time. My stock is a Silicon Valley stock, but it's not a FANG stock. They went on to resist an Apple buyout, and then Photoshop and PDF were theirs. Given your track record of naming great pets after great companies, should I call my next puppy dog Adobe?
Well, let's see. Kind of depends on the breed. I would tell you this. Adobe is where it was after they reported the so-called bad quarter when Shantanu Ryan came on Squawk on the Street, and I thought told a very compelling story, and I want to be long Adobe, not out of Adobe. I think you have a good one, not a dog namer, but a good stock. All right, some of these pandemic plays that are surging will be one-and-done moves. All right, they absolutely will. These are not great stocks because there are things wrong with every single one except for AMD. I think the higher quality names have overshot the downside, including AMD, and can bounce for more than one day. On Mad tonight, Qualcomm, talk about a stock that flamed out, completed its deal for advanced driving system Arriver. So this is, remember, ADAS. Could the deal drive the stock even higher? I'm going to talk to the CEO. Then, with the first quarter of 2022 in the books, I'm recapping all the action, highlighting the winners and calling out the underperformers. Plus, the Wonder Truck made a special visit to CNBC today. I'm asking the top brass, who you will love, of startup group Wonder Group, all about the company's plans to get 1,000 of its food trucks on the road just this year. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.